one more person that's going to come up and do the introductions of our speakers today is Phil Lewis, Eller Lewis and Loeb Realty's advisors. I want to say continue eating if you still have some food and enjoy your dessert. And also we have a drawing for an iPod donated by me. So anyway, if you put your card in the bowl, great. If you didn't, Michelle's going to come around. If you just put your hand up, she'll get your card from you. We'll do that after the program. But thanks again for being here, and I'm going to get Phil Lewis to come up now and start our program. Thank you.
Good afternoon. Appreciate y'all coming out today. Do we have any regulators in the audience? If you're here, you probably ought to run pretty quickly, because by the time our speakers finish this afternoon, you're going to be marked targets. I think y'all are having sat in on a lot of conversation at the table. I think y'all are in for a real treat this afternoon. First, we're going to hear from John Heasley. John is the General Counsel and Executive Vice President of the Texas Bankers Association. He drove in from Austin to kind of give us a perspective of what a lot of us in the business have a tendency to blame the bankers, saying they just won't give me that money that I want. And they're here to tell us why they can't give us the money and some of the new rules that are going to be faced under the new act that was just passed. John started out as a prosecutor in Dallas, which makes me nervous. I think the statute of limitations has expired on most of that now. He then spent some time with Congressman Bartlett in Washington. He worked for the House Banking Committee, and he's been with the TBA since 1994. Following up John's comments, we're going to hear from Julie Kripe. Julie is the chairman of OmniBank, and she's also the chairman-elect for the Texas Bankers Association. So I think there's going to be a real nice blend of follow-up to what the Texas Bankers Association is trying to do for everybody, plus some real on-the-street news about what a good-sized community bank is faced in trying to, they have to make money too, believe it or not, with what they're faced here. Each of them are going to do a presentation that's about 15 minutes, and then we're going to follow that up with questions and answers. And so would y'all please welcome them up and get your questions ready. Thank you.
Thank you, Phil. I appreciate the opportunity to come to Houston and allow me to escape the people for public law school. So I know exactly what you wanted to hear from as a lawyer and a lobbyist for the banking industry at large, but I'm going to give it my best. Julie, as well as no other bankers and myself, have been up to Washington about half a dozen times prior to the July 21st signing of the Dodd-Frank Act of 2010. I think they called it that because if they called it the Frank-Dodd Act, we would be more inclined to call it the Fraud Act of 2010 when it comes to the effect it has on the industry. I have a very brief presentation with a couple of slides, and Julie will have some more pragmatic aspect from the lender's perspective on how it will affect real estate lending. I have been through all 2,300 pages of the bill, and yes, I'm that much of a geek. I also watch C-SPAN on weekends, so you can really tell I'm the kind of guy to hang out with. And a lot of this is going to be speculation on my part is how it really will affect the industry. I'm very, very concerned about the effect that this bill will have on community banks. Not only their profitability, but their ability to.
You're taller than me, so.
I'm very concerned about the effect this bill will have on the profitability of community banks and also their ability to make loans to small businesses and other types of loans, within Texas. Do a little background. Those of you, I know I've talked to some folks here that have been through the 1980s. It is a very different time where we had more localized regional depression, essentially, and it was treated very differently then as it was now. It was pretty much the sheriff came down with the FDIC badge and essentially put a bullet into whoever they thought was necessary, and then went on and gave the detritus to the RTC, and that's what we had to deal with in Texas. We also had a situation at that time that was happening in Texas, but rather than any other place in the world, that's where the homeowner would walk out of their home and put the keys in the mailbox and maybe move it down about half a mile and then get another particular mortgage. It was viewed as a situation that was treated differently by the regulators, and now that phenomenon is happening in the rest of the country. We suffered at that time 500 outright bank failures, 200 thrift failures. So far in the rest of the country, we only have a handful. In Texas, we've had 276 bank failures, and we're expecting approximately 500. The total realm of failures, let's put this in historical perspective. The savings and loan crisis, what we dealt with in Feria back in 1989, the Fiducia Act in 1991, two bills that I worked on. The total savings and loan crisis was $150 billion. Right now, we're over $3 trillion in obligations of the federal government. Through the Federal Reserve, through the $700 billion in TARP spending that you heard about that was passed in the fall, in October of 2008. And the Fed is not only acting as a lender of last resort, the Fed has over $1 trillion in things like mortgage-backed securities on their books still. You don't hear a lot about that. I'm worried about the Fed in a lot of things, essentially monetizing the American debt. But we are not out of this particular crisis. And unfortunately, I have some concerns that the particular administration we have right now might be exacerbating the banking situation before we can actually make it out of this crisis. Now, that being said, it's still good to be in Texas, folks. We're an island of stability in an ocean of turmoil. Now, if you go to Arizona right now, if you buy a toaster, they will give you a bank. Just like we're in pretty good shape. Now, yes, we have some loan demand issues that Julie would tell me about. It's a very strong concern as far as our bank regulators are concerned. But before we get into the specifics of the bill, let's go back to how tenuous it was in the fall of 2008. Remember, at that particular time, when George Bush was still president, the stock market, with the House failure to act on $700 billion in TARP money, the stock market dropped 700 points in one day. The Senate had to end up acting, and the House passed it. But if you look at the freeze that essentially was happening internationally, it was all a result of American toxic mortgages. It's amazing how about $1 trillion of toxic mortgages issued, usually not in Texas. Texas probably had the lowest amount. There's a lot of reasons for that. We don't have time to get into it. But $1 trillion in American mortgages, a lot of them, for example, issued between 2004 and 2006. In the entire United States, over half of those loans had zero down payment and no or low documentation. The mean down payment for a mortgage during that time was 3%. All that toxicity was bundled up, given AAA ratings, sold throughout the world, and then insured with credit default swaps. That ensured that in the fall of 2008, the total panic and shut. It wasn't a panic in the sense that people were jumping out of windows on Wall Street, but the banks did not trust each other, and people were lining up at the Fed as a lender of last resort. So that happened in the fall of 2008. 2009, we get a new administration. A lot of the same players are involved. I think Paulson at Treasury is Tim Geithner, who was involved there very much in dealing with the crisis in 2008. Go through 2009, July of 2009, the House Banking Committee passes a bill that is only a mere 1,400 pages in length. It has a lot of very onerous things that Julie and others that represent the Texas banking were saying, you know, what you're trying to fix, or should be trying to fix, is the situation that got us in this particular area, how we were forced to have to abandon everything we had and bail out AIG, the largest insurance company in the world. How we had to come in the aftermath of the Lehman Brothers. Instead, this particular administration, through White House Chief of Staff, Rahm Emanuel, said never let a good crisis go to waste. So what they ended up doing was getting an entire legion of consumer laws that they had not been able to pass before and put that into the law. I'll belabor on the consumer law to a certain extent, because now you will have a new what's called the Bureau of Consumer Financial Protection. This will be an agency probably as large or larger than the Internal Revenue Service. It will be designing, prohibiting and pricing products designed in Washington, D.C. It will be totally separated from a safety and soundness regulator. And have the ability to go and look at each and every customer's personal records. It also has the duty to report personal customer information to the Internal Revenue Service. This had nothing to do really with the crisis at hand. And what makes us particularly